Welcome to Moving Averages Part 2, presented by Daily FX Education. Moving averages are one of the most popular, widely used, and easy to implement tools available in technical analysis. Their primary purpose is to smooth a data series to make it easier to spot trends, something that is especially helpful in volatile markets. They also form the basis for most other technical indicators and overlays. In the first video, we went over numerous aspects of moving averages. In this video, we'll recap and elaborate on some of those and then move on to how to employ moving averages in actual trading situations. Let's begin by expanding on some of the areas covered in the first video. To review, moving averages recap the average closing prices of a currency pair over a specified period of time. On a daily chart, for example, a 100-period moving average would be calculated by taking the closing prices for the previous 100 days, or 100 daily candles, adding them up and dividing by 100. Each time a new daily candle closes, it's added on the right side of the chart and is taken into the average. As a candle is added on the right, a candle is dropped from the left side of the chart, the 101st candle in this case, and the updated average is then plotted. If we were to go to an hourly chart with a 100-period moving average on it, we would be taking the closing prices for the previous 100 hours, or 100 hourly candles, adding them up and dividing by 100, as we're still using the 100-period moving average. As was the case in the example above, each time a new hourly candle closes, it's added on the right side of the chart and is taken into the average. Additionally, a candle is dropped from the left side of the chart, the 101st candle, and the updated average is plotted. Here's an hourly chart of the euro-dollar, with a 20-period simple moving average plotted on it. All the same rules we explained regarding the 100-period moving average would apply, except we're now applying those rules to a 20-period moving average. As a trader moves among the various charting time frames, the moving average is recalculated with the time frame of the various charts each taken into account. As a general trading rule, the longer the time frame of the chart employed, the more reliable the data. Since a longer time frame chart encompasses a greater number of data points than a shorter time frame, more reliable feedback can be obtained. The same is true with moving averages. A moving average based on the previous 100 days of data offers greater reliability for trading than a moving average compiled using the previous 100 hours of data. Hence, a 200-period moving average, or the previous 200 candles, is more reliable than a 100-period moving average. The 100-period moving average is more reliable than the 50-period moving average, and so forth. Since all moving averages are based on price action, it's reasonable to assume that one moving average is as good as any other since they all are compiled from the same price movement. Each average is simply viewed through a different perspective of a different time frame. The most widely used moving average periods are 10, 20, 50, 100, and 200. While any moving average or series of moving averages can be set up and show how prices have been moving, it's valuable to view periods the majority of traders are viewing. As more people buy a currency pair, its exchange rate increases. As more people sell a currency pair, its exchange rate decreases. Therefore, using the same indicators and indicator settings that the majority of traders are using, we can increase the likelihood that we end up on the right side of the trade. This chart shows how the 5 primary simple moving averages compare to one another on the same chart. We can see that the fastest of the 5, which is the 10-period simple moving average, is the most sensitive to price action, while the slowest SMA, the 200-period, is the least sensitive to price action. Again, utilizing the most widely used moving averages, traders can base their trades on what the market is doing and what the majority of traders are viewing in actuality. When a simple moving average is compiled, each period is given the exact same weight in the calculation. The data going back 100 candles is evaluated in the same way that the most recent candle is evaluated. When using an exponential moving average, however, the most recent candles are weighted more heavily in the calculation. The thinking on this is that the more recent price action has a greater value in determining the direction that the pair might move going forward, and reduce the lagging tendency inherent in moving averages. Exponential moving averages reduce the lag by applying more weight to recent prices relative to older prices. The weight applied to the most recent price depends on the specified period of the moving average. The shorter the EMA's period, there is more weight applied to the most recent price. A 10-period exponential moving average weighs the most recent price 18.18%, while a 20-period EMA weighs the most recent price 9.52%. The important thing to remember is that the exponential moving average puts more weight on recent prices, so it will react more quickly to recent price changes than a simple moving average. Whether or not this makes the EMA a more valuable trading tool than the SMA is open to debate among traders. While the exponential moving average is consistently closer to the actual price, the usage of one over the other is largely dependent on the strategy being employed, and often the predisposition of the trader in question. This chart exemplifies the difference between the two moving averages on a daily chart of the dollar-CAD pair. It can be seen that the two mirror price action in much the same way, but that the EMA, or exponential moving average, is more sensitive to recent price movements than the SMA. There are many benefits to using moving averages in your trades. Whether used in combinations or alone, they graphically depict the direction the price moved. When used in combinations, 10, 50, and 100 for example, they can show on a single chart how prices moved in various time frames. A trader can see at a glance how the shorter, faster moving averages are moving relative to the longer, slower moving averages. This comparison can be beneficial in a trending market, where the trader can observe price action retracing on a shorter moving average, a 10-period for example, and take note of when the retracement has finished, and then enter the trade back in the direction of the longer moving average, or 200-period moving average for example. On the daily chart of the Australian dollar-US dollar pair, we have three moving averages on the chart: the 10-period, 50-period, and 200-period. Based on the 200 SMA, we see the pair is trending up. On the 10-period SMA, it's moving against the overall trend of the pair, retracing down below the 50 SMA. If the 10-period SMA moves back above the 50 SMA in the direction of the overall trend, it would signal an opportunity to buy. This example provides insight as to how moving averages can be used in trending markets. They're put to much better use in trending markets as opposed to range-bound markets. In a ranging market where the price action does not make new highs or new lows, the moving averages can become entangled and not really provide usable trading data. Many traders feel that moving averages lag the market more than other indicators and are less precise than indicators such as the Fibonacci tool. Since all indicators are based on an average of previous price action, they lag the market to a degree. When using a greater number of periods in the moving average, the lag is more pronounced but more reliable. When using a lesser number of periods in the moving average, the lag is less pronounced but less reliable. Again, since moving averages are based on just that, averages, some traders feel they lack precision. The precision of a Fibonacci level, for example, which provides exact entry and exit levels. Keep in mind that we're measuring two different things here. On the one hand, the moving average provides a running average, or in other words, is in a constant state of change. The Fibonacci tool measures something that is static in nature, a previously completed move in totality, so by definition, the results that will be provided will be quite precise, since it's based on a constant. Moving averages, when compared to other indicators, in my opinion, are no better or worse, simply different in the feedback they provide. This is the case as you learn about various trading indicators and compare one another. Now, we've reviewed moving averages. Let's move into how they can be implemented in specific trading conditions. These conditions include how to use moving averages to determine support and resistance levels, how to determine the trend, how to identify entries and exits, and also how to use moving averages in conjunction with other indicators. The moving averages themselves represent levels of support and resistance. For example, a trader puts a 50-period moving average on a chart. Then he observes how price action seems to respect the bounds of the moving average by not closing below it or above it, depending on the direction that the pair is moving. If that's the case, in an uptrend, the trader can use the moving average as a support line. Each time the pair trades down to the moving average, a long position can be taken with a stop just below the 50-period moving average. The reverse scenario would be true if the pair were in a downtrend. Also, this can be used as an exit strategy when the pair closes below the 50-period simple moving average. This scenario can be employed using any moving average and following the same principles, but keep in mind the shorter moving averages can be used in short-term trading, while longer moving averages are more likely used in long-term trading. One way to determine which moving average would best serve as a support level on a particular chart is good old trial and error. Place each of the major moving averages, the 10, 20, 50, 100, and 200, on a chart and see which one, if any, consistently acts as a support level or resistance level in a downtrend. And then use the moving average going forward to make trading decisions. Also, on this daily chart, it can be noted how at different times of the trading history of the pair, different moving averages represented different levels of support for the pair. There are a couple of ways moving averages can be used to determine the direction of the trend. The first is simply by eyeballing the moving averages on the chart. Let's say there are 20, 50, and 200 period SMAs on this 1-hour dollar-yen chart. If price trades below each of those levels, clearly the pair is in a downtrend. If price action was above the three moving averages, the opposite condition, an uptrend, would be depicted on the chart. More than one moving average on a chart affords the trader more insight as to how the pair is moving. In the case of the dollar-CAD pair, price action remaining below the 200-period SMA, so we know the downtrend is still in place. As price action moves above and below the two faster moving averages, we know that the pair was oscillating on both the 20 and the 50 moving averages. We can also see those two moving averages are moving closer and closer to the 200-period simple moving average. Based on that, we can tell the strength of the downtrend is waning. Should the faster moving averages break above and close above the 200-period moving average, we'd look for upside potential in the trading of this pair. If the moving averages are angling to the upside, we have an uptrend in place. If they're angling and working their way to the downside, we have a downtrend in place. The key moving average in determining the trend movement is the 200-period SMA. As a general rule of thumb, when price is above the 200 SMA, on a daily chart, a bullish uptrend is in place. If price is pulling away from the 200-period SMA, the trend is strengthening. If it's moving closer to the 200-period SMA, the trend is weakening. Keep in mind that when using moving averages or any other indicator, the best signals are those that are in the direction of the trend on the daily chart. In other words, if a pair is in an uptrend on the daily chart, for a higher probability entry, we'd wait for the moving average to move in the same direction as the trend. When using moving average to determine entries and exits, we mentioned earlier if a pair breaks above on a moving average on our chart, that can signal a buying opportunity, while breaking below a moving average can signal a selling opportunity. We can also use the moving average to determine where to place our stops. In an uptrend, the stop is placed below the moving average that was used for our entry. In a downtrend, the stop is placed above the moving average used for our entry. If we have multiple moving averages on our chart, we can employ a slightly different strategy for determining our entries and exits. Let's take a look. Here, the 20-period, 50-period, and 200-period SMAs are on this pound-yen chart. In this case, in a downtrend, a short entry signal is generated when the 20-period SMA, the fastest of the three, crosses below the 50-period SMA and below the 200-period SMA to the downside. That indicates bearish momentum is in place. After the crossover, the 20-period SMA begins to pull away from the 50 and the 200, while the 50 begins to pull away from the 200. This indicates the move is gaining momentum. Anytime we see the angle of the moving averages increasing and the separation between the moving averages increasing, we know momentum is picking up in the direction of the angle of the crossover, meaning more price action will be covered in a shorter period of time. Conversely, there's a buying signal when these three moving averages begin to cross over each other, this time to the upside. It also signals to exit any short positions in the pair the trader might still hold. Using moving averages in conjunction with other indicators offers potential confirmation to what the moving averages alone can provide. On the pound Swiss 4-hour chart, we see how the MACD can be combined with moving averages. In two cases, MACD confirms the action indicated by the moving averages, while in the third instance, MACD provides an earlier indication of what price is likely to do. On the dollar Swiss 4-hour chart with the RSI on it, we can see how the RSI signals a bullish move ahead of the signal that would be provided by the 10-period SMA. Even though the moving average signals a buy after the RSI, by using the RSI to signal to confirm the moving average signal, the primary point to be learned here is that they both do confirm a bullish move. In many instances, it will be the lagging indicator that provides the stronger confirmation since it's based on a greater number of data points. Ultimately, it's better to enter a trade later and be right than to enter a trade early and to be wrong. When using slow stochastics in conjunction with moving averages, once again it can be seen that slow stochastics signals a short entry prior to the time that a candle closes below the 10-period moving average on this 4-hour chart of the dollar-yen pair. As you may have already surmised, moving averages are an integral part of many of the indicators that traders currently use. For example, MACD, stochastics, and Bollinger Bands all employ moving averages. MACD employs a short-term 12-day moving average and a longer-term 26-day moving average to arrive at the trading signals it provides. The middle line of the Bollinger Band indicator is a simple moving average which moves between the upper and lower bands. The upper and lower bands are derived from a standard deviation calculation that determines the level they should travel above and below the middle line. Also, the two lines comprising the stochastics are both moving averages as well. So beyond the more straightforward manner in which we've been discussing moving averages, it's clear that they play a more in-depth role in the use of many of the technical tools that traders use on a regular basis. Taking the above and looking at it in a different way, we can also place a moving average on an indicator that we already use to fine-tune it even a bit more. Let's say that we have a 14-period RSI indicator on our chart. We can bring a moving average into play by placing it right on the RSI and gain an additional trading signal as we see how the moving average moves relative to the RSI. Take a look at this chart with a 3-period moving average placed over the RSI. On the chart, the RSI is represented in orange, while the 3-period moving average is in black. We can see that when the RSI crosses over the 3-period SMA to the upside, price action on the chart reflects this, and there's a bullish move. Conversely, when the RSI moves below the 3 SMA, a bearish move to the downside ensues. If a trader took a long position based on a bullish crossover, they may choose to exit the long position on a bearish crossover. The opposite would be true in the case of the trader taking the short position. As you may have noticed, this is very similar to how the MACD indicator signals entries and exits into trades. To place a moving average on the RSI indicator, right-click on the RSI portion of the chart. Click on Add Indicator. Then, in the Add Indicator window that appears, click on MVA for Moving Average. Then, click on the Parameters tab to set the period of the moving average to be used. When that's been done, click OK, and the moving average will appear on the RSI itself. Moving averages can be effective tools to identify and confirm trend, identify support and resistance levels, and develop trading strategies. Moving averages are trend-following or lagging indicators that are always a step behind. This is not necessarily a bad thing, though, as we mentioned earlier. After all, the trend is your friend, and it's best to trade in the direction of the trend. Moving averages help ensure that a trader is in line with the current trend. However, currencies spend a great deal of time trading in ranges, which render moving averages largely ineffective. Once in a trend, moving averages keep you in, but also give late signals. Don't expect to get out at the top and in at the bottom using moving averages. As with most tools of technical analysis, moving averages are best not used on their own, but in conjunction with other tools that complement them. We hope you found this video helpful, and we do encourage you to attend one of our live webinars on moving averages with our course instructors. In the webinar, instructors will relate to you what you have learned here to current market and trading conditions, including some patterns that may be in the process of forming right now. Instructors will field live Q&A on the topic of moving averages. Thanks for listening, and we look forward to seeing you in the webinars.